Welcome to Truth Behind History. The stories are real, the impact is lasting. Today, we're diving into the tangled web that set the stage for the 2008 financial crisis. A collapse so vast, it didn't just shake Wall Street, it rippled through main streets across the world. But here's the kicker. The seeds of disaster were planted long before the first bank folded. And what if I told you the system looked its strongest just before it fell apart? Let's start by unpacking the illusion of stability. In the 1990s and early 2000s, America saw a steady climb in home ownership. People were buying houses, lots of them, and lenders were more than happy to hand out the keys. Credit was cheap. Mortgages were easy to get. Banks and borrowers alike were convinced that the good times would roll on forever. On the surface, it all looked like progress. But beneath the surface, a dangerous myth was forming, the belief that housing prices could only go up. That belief, however comforting, wasn't grounded in reality. It was grounded in debt. Now, let's add deregulation to the mix. The Gramm-Leach-Bliley Act of 1999 and the Commodity Futures Modernization Act in 2000 essentially tore down the walls separating different arms of finance. Commercial banks, investment banks, insurance firms, suddenly they could all play in each other's sandboxes. Sounds innovative, right? Maybe, but it also meant that risk was no longer compartmentalized. The financial sector became a house of mirrors, where everyone was exposed to everyone else's bets, and no one was watching the whole table. And then came the Federation. After the dot-com crash and the shock of 9/11, the Federal Reserve slashed interest rates to historic lows. It was meant to stabilize the economy, and it did, temporarily. But those rock-bottom rates sent investors searching for yield anywhere they could find it. Risky bets became standard practice. And the real estate market? It became a feeding frenzy. Loans went to people who couldn't afford them. Banks packaged those loans into products they barely understood. And all the while, the foundation beneath was cracking. So ask yourself, when cheap money, financial deregulation, and a national obsession with home ownership all collide, is it any wonder that something was bound to break? Stay with me, because next, we'll peel back the curtain on the financial wizardry that turned mortgages into weapons of mass destruction. Now that we've set the stage, let's dive into the machinery that powered the meltdown itself. This is where financial innovation didn't just go off the rails, it built new tracks into a canyon. First up, financial engineering. Mortgage-backed securities and collateralized debt obligations, MBSs and CDOs, sound complicated, right? That's because they were. These instruments bundled together thousands of home loans, slicing them into different layers called tranches. The idea was simple, spread out the risk. But here's the twist, many of those loans were subprime, meaning they were given to borrowers with shaky credit histories. Yet these toxic assets were stacked, packaged, and sold to investors all over the world, under the assumption that they were safe. Why? Because they had AAA ratings from credit agencies. We'll come back to that mess in a second. Let's talk about the enablers, institutions like Fannie Mae and Freddie Mac. These government-sponsored enterprises played a key role in securitizing mortgages. Alongside private banks, they kept the pipeline of subprime lending flowing. Why slow down a booming market when everyone seems to be winning? But what looked like safety was really a mirage. These entities created a false sense of security, giving the green light to ever riskier lending. And now, the elephant in the room, ratings arbitrage. Credit rating agencies like Moody's and Standard & Poor's were supposed to be the referees. But instead, they were more like cheerleaders. They gave AAA ratings, the highest possible grade, to bundles of loans that were, in reality, ticking time bombs. Why? Because the agencies were paid by the very institutions whose products they were rating. That's like letting students grade their own exams. The conflict of interest was baked into the system, and nobody seemed interested in stopping it. So what do you get when you combine financial complexity no one fully understands, with massive conflicts of interest, and a market drunk on the illusion of safety? You get a machine that can't be stopped until it breaks. Next, we're heading straight into the moment everything snapped. The fall of Lehman Brothers. And when that domino fell, the whole world felt it. So, what happens when the music stops? Let's talk about Lehman Brothers. September 2008. A 158-year-old investment bank. Gone. Overnight. It wasn't just a bankruptcy, it was a seismic event. One of the largest financial institutions in the world folded, and suddenly, the illusion of stability shattered like glass. Investors panicked, banks stopped trusting one another, liquidity froze, and the question everyone was asking was, who's next? But let's back up. Why was Lehman so important? Because it was deeply entangled in the toxic mortgage assets we just talked about. And once the value of those assets plummeted, Lehman couldn't cover its obligations. No one wanted to buy them out. And unlike Bear Stearns or AIG, the government chose not to intervene. That decision, right or wrong, was a turning point. It told the world that not everyone would be saved. And that scared people more than any subprime loan ever could. In the aftermath, the government scrambled to contain the damage. Emergency measures rolled out fast. The Troubled Asset Relief Program, TARP, was approved to inject capital into the banks. The Federal Reserve opened the floodgates with liquidity injections. AIG, which was teetering on the brink, got a bailout. These weren't band-aids. They were tourniquets to stop the bleeding before the entire system flatlined. But the damage was already spreading. What started as a housing crisis in the US had become a global contagion. European banks, many of which had bought into American mortgage-backed securities, began to wobble. Iceland's banking system collapsed. Stock markets across Asia tanked. Confidence, the invisible glue of global finance, was unraveling fast. This wasn't just a financial failure. It was a trust crisis. And once trust is gone, panic moves faster than reason. Next up, we'll zoom out and look back in time. Because if this all sounds eerily familiar, it's because we've seen it before. You know the old saying, history doesn't repeat itself, but it sure does rhyme. And when we look at the 2008 crisis through a wider lens, we start to notice some unsettling echoes from the past. Let's rewind to 1929. The Roaring Twenties were just that, roaring. The stock market was booming. People were borrowing money to buy stocks on margin, convinced they couldn't lose. Sound familiar? That leverage-fueled speculation led to a brutal collapse. When prices dropped, margin calls hit hard, and the selling spiraled out of control. The Federal Reserve was slow to act, and by the time it tried, the economy was already in free fall. What followed was the Great Depression. Fast forward to the 1997 Asian financial crisis. Countries like Thailand, South Korea, and Indonesia were growing fast, but underneath the surface, things were fragile. Fixed exchange rates and massive inflows of foreign capital created bubbles. When those bubbles burst, the International Monetary Fund stepped in with harsh austerity measures. The result? Devastating recessions, social unrest, and long-term economic scars across Asia. Again, we see a pattern: short-term capital flows, rigid systems, and external interventions that often made things worse before they made them better. And that brings us to the most important piece: pattern recognition. What do these crises have in common? Distorted incentives, overconfidence, moral hazard. Time and again, we see systems where risk is ignored, accountability is blurred, and everyone assumes someone else is watching the wheel. Until no one is. So when people say no one could have seen it coming in 2008, they're not paying attention. The warning signs weren't hidden. They were historical. In our next section, we're going to shift focus from the system itself to the people who lived through the fallout. Alright, let's talk about the human cost, because while the headlines focused on banks, bailouts, and billion-dollar losses, the real pain was felt far from Wall Street. Start with the homeowners. Millions of Americans, many of them first-time buyers, lost their homes. Foreclosure signs popped up like weeds across entire neighborhoods. Families packed their lives into boxes and walked away from what was supposed to be the American dream. Some were misled, others were over-leveraged, but almost all were caught in a system that rewarded pushing credit, not protecting stability. And the damage didn't stop at the front door. Communities were hollowed out. Local governments lost tax revenue from property values plummeting. Public services, schools, libraries, parks, were strained or shut down. In cities like Detroit, entire blocks were abandoned. It looked less like a financial correction and more like economic collapse. Then there's inequality. The top recovered, the bottom didn't. The government's response, though swift, disproportionately helped large institutions. The Federal Reserve's quantitative easing pushed asset prices higher: stocks, bonds, real estate. Great, if you own them. But most working-class families didn't. They watched their wages stagnate while wealth concentrated at the top. A widening gap formed, not just economically, but psychologically. People began to lose faith in the fairness of the system itself. And from that frustration came politics. The rise of populism, both left and right, wasn't a coincidence. It was a backlash. People wanted someone to blame: banks, elites, politicians. Movements formed. Anger turned into action. And the political landscape across the US and Europe began to shift in dramatic, sometimes unpredictable ways. So who paid the price? The people least responsible. The ones who didn't get a bonus or a bailout. The ones who were told to trust a system that failed them. Next, we'll take a look at what happened in the aftermath. What changed, and just as importantly, what didn't. So, after the dust settled, what actually changed? Well, let's start with what did. In 2010, Congress passed the Dodd-Frank Act. It was a sweeping piece of legislation meant to rein in the excesses of Wall Street and prevent another crisis. It created the Consumer Financial Protection Bureau to keep an eye on predatory lending. It aimed to make banks hold more capital, and it put new regulations on derivatives, the very tools that helped light the fuse in 2008. Sounds like progress, right? Well, sort of, because while Dodd-Frank addressed some of the worst abuses, many of its provisions were watered down before the ink was dry. Lobbyists went to work. Enforcement was inconsistent, and over time, parts of the law were rolled back entirely. The spirit of reform was there, but the muscle behind it, not always. Then there's the bigger issue, too big to fail. That phrase wasn't just a headline, it was a warning. In theory, Dodd-Frank gave regulators the tools to wind down failing financial institutions in an orderly way. But in practice, the biggest banks today are even bigger than they were before the crisis. Consolidation increased, complexity deepened, and the assumption that the government will step in during a meltdown, still very much alive. Meanwhile, monetary policy did the heavy lifting. The Federal Reserve slashed interest rates to near zero and kept them there for years. It bought trillions of dollars in assets through quantitative easing. That helped stabilize markets, but also created side effects. It inflated asset prices, it encouraged risk-taking, and it made the wealthy wealthier. So yes, some rules changed, but many of the incentives stayed the same. And that raises a critical question: did we fix the system, or just patch it up and hope the next storm takes longer to arrive? Next, we'll tackle that very question, and explore what the future might look like from here. So here we are standing at a fork in the road. After everything we've unpacked, the bubbles, the bailouts, the backlash, we have to ask, what now? Because this isn't just about the past, it's about the system we're still living in, and the decisions we make moving forward will shape how resilient, or how fragile, that system becomes. Let's start with centralization. The financial system today is still dominated by a small number of massive institutions. Banks, central banks, global regulators, they're interconnected in a web so dense that one failure can still threaten the whole. That's the problem with central planning at scale. It assumes the people at the top can see everything and get it right. But history shows otherwise, which is why there's growing interest in decentralization. Blockchain, crypto, peer-to-peer finance. These aren't just buzzwords. They're part of a broader movement, one that questions whether trust needs to be placed in institutions at all. Could we build systems that rely on code, not committees? On transparency, not trust? Maybe, but those systems have their own risks, and they're not immune to greed, speculation, or manipulation. Then there's the question of responsibility. The 2008 crisis exposed a deeper issue. Too many decisions were made with the assumption that someone else would clean up the mess. That's not just bad finance, that's bad ethics. The future needs more than new tools. It needs new mindsets, local accountability, personal responsibility, clear incentives that reward long-term thinking, not short-term profit at any cost. So here's the lesson: stability doesn't come from complexity. It comes from clarity, from systems where risk is visible, where choices have consequences, and where no one is too big to fail or too small to matter. In our final segment, we'll wrap this all together, not with fear, but with a challenge. The 2008 financial crisis wasn't just a breakdown of banks. It was a breakdown of belief in systems, in leadership, and in fairness. But crisis has a strange way of sharpening the view. It exposes what was hidden, it reveals the cracks we chose to ignore, and it forces us to ask better questions about money, about power, and about who bears the burden when things fall apart. What we've seen in this journey, from the false sense of stability, to the complex collapse, to the uneven recovery, is that the consequences of centralized failure ripple far and wide. The people at the bottom paid the highest price for risks they didn't choose. And that truth matters, because this isn't just history, it's a mirror, and it's asking us, what kind of systems do we want to build going forward? Do we double down on complexity, trusting a few to manage risk for the many? Or do we rethink the foundations, pursuing transparency, personal responsibility, and voluntary cooperation over coercion and bailout culture? These are not just economic questions, they're moral ones. So the next time someone tells you a financial crisis came out of nowhere, remember what we talked about today. And remember this: the truth behind history isn't just about what happened, it's about what we choose to learn from it. If you found this video insightful, make sure to like, comment, and subscribe to Truth Behind History. We've got more deep dives coming, more stories that challenge the surface and bring you face to face with the systems shaping our world. And if you enjoy thoughtful, engaging content about economics, power, and the lessons buried in time, check out our other videos, because understanding history isn't just about the past, it's about being ready for the future. Thanks for watching.